that the bond market's just way ahead of itself in terms of what's going to happen from an easing perspective. Mark is asking, if there's little or no easing, where are the danger areas on a sector or asset basis? Well, I think we just discussed the fact that bonds look like they'll need to reprice. Would you expect, and it sounds like you're saying you can expect more of that on the short end? I mean, where would you be most concerned about bonds?
Yeah, I mean, I think that the short end pricing is the most extreme in terms of the mispricing, and we've seen a few cycles of this. Like
last year, it killed everyone.
How many narratives did we have last year? We went from recession now to start the year, to higher for longer, to credit crisis, to higher for longer, to Fed cutting 160 basis points. We go up and down, and I think this is kind of the complexion of the market. If you look back over the last 15 years, people have sort of learned to follow the trend, and so you wanted to catch the twists in the trend because the trend's extended for a long time. But what we've had really over the last 18 months is we've had the macroeconomy, sort of the aggregate trend of the economy, sort of meandering, not really moving very much. And you've had expectations whip around up and down and up and down. And you've actually been in a better position to fade extreme pricing than you have been to try and call the trend shift. And I think we're in another one of those circumstances where the pricing got a little overextended, particularly at the end of the year. And we're now sort of fading back to a more reasonable pricing dynamic.
I think I just want to underscore that, because I think that this is a really, really important point, because this is kind of a strategy, right? And I think you're really giving voice to the fact that everybody has recency bias, and what served you well is catching the turn, right? Getting ahead of what everybody else was a beat later on seeing, and that was a turn in the cycle. But you're saying now, or the turn in prices that identified a change in conditions.
Right.
What you're saying now is really, it's hard to tell what's going to happen. So be on the lookout for an overextension and sort of fade what looks like an extreme move, because we've seen it. Does that mean there's more volatility? Does that suggest that we're just in a more volatile period and you're going to want to look out for those overextensions?
Yeah, I think we've seen a lot of overextensions. Part of that, I think, is the uncertainty, a lot of uncertainty in the market about how it will respond, how the economy will respond to the monetary policy that we're seeing. Mm-hmm. And so in some way, and circumstances that people haven't really seen in their careers. So I think a lot of people, as an example with the SVB circumstance, didn't really have the benchmarks and the depth of understanding to recognize, was this like a 2008 crisis, or was this, not that big a deal? And so, they went right to crisis because that was a bit of a framework that they had, or an easy way to move into the market, and then backed off of that as they realized it's not that big a deal, all things considered, and plus the government responded to it.
Yeah, well, that's what makes it confusing, right?